Hey, so welcome to Space and Equity. We're all about increasing assets and creating new space. If you like this content, like and subscribe, hit the like button. We'll continue to produce content about twice a month. But I want to talk today about what's going on in the banks. So the regional bank level, typically these are banks about 50 billion and below in assets. There's definitely been a tightening in credit. What I mean by tightening just means that it's harder to get a loan, a business loan, or more scrutiny. So same rules are always in effect, but they're going to be more stringent in underwriting. For a bank, your checking account that does not earn interest is the cheapest form of liability to the bank, meaning something that the bank owes. Your checking account gets leveraged about 90 cents on the dollar, and it doesn't cost the bank when it's a non-interest account. So it increases the margin. The bank doesn't have to pay you interest for that. You have to maintain it, but doesn't have to pay you interest on it. Well, margins are best served when you're not paying interest. Now, if a bank has to grow its deposits and it's offering, aggressive CD rates or money market rates, then the margin is squeezed on the loans that you offer. So even though the Wall Street Journal prime rate is high at 5.2 to 5.55%, which means the banks, if it's at 5.2, 5.55, that means what you receive when you get Wall Street prime plus zero is 8.5. Well, when you have that 8.5 and you're not paying any interest on the checking account, that's the most ideal. But your mix of deposits is typically, in a good scenario, in a great scenario, maybe 60% checking, 40% CDs, money market stuff that the bank is paying the client interest on. In some cases, it's in the invert or more in the interest-bearing accounts than the non-interest or demand deposit accounts. So what that means is the bank has an expense on the loan. So even if you could say, well, all right, I'm charging the client 8.5% on the loan, and I'm paying 5% on the deposit. You're like, oh, that's 3.5%. But there's still costs and expenses that squeezes that margin to 2% or 1.5%. So again, it's ideal to have checking accounts for the bank's perspective that they don't pay interest on. But to have that, you have to offer your customer something in return. Sometimes that offering something in return is convenience of your locations. Well, those are the larger banks. Sometimes that offering or the return is, hey, I have my mortgage there, I have my insurance. It's ease of use with the technology, but you have to offer something. Maybe I've provided a commercial loan and there's a requirement for to keep your deposits, but most of the time it's harder for a smaller bank or a regional bank to gain deposits because they don't have the infrastructure that a Chase would have, where you could open an account online easily. You have the convenience of locations, you have the convenience of technology. So they have to get their customers, their deposit base is based on people, by and large, that they provided loans to. When it's tighter, so to make a long story short, banks are looking for deposits, still offering loans as it pertains to, on the business side, owner occupied loans. This means that, hey, your business is operating there. You are a dentist, you own the building, and the bank is loaning on that building that you own. You're basically repaying from the cash flow of your operations. Those type of loans are great, are still going. Relatively, in today's market, still competitive interest rates from a historical standpoint. If you can get a commercial loan on an owner occupied, and right now probably in the low 7% range on owner occupied. Sometimes there's specials where it's 6%, 6.5% on owner occupied. If you're looking at investment property, you're 8.5%, maybe 9%, and it's going to be more stringent to do, meaning your down payment will be more than it was 2 years ago. On an investment property, if the bank is doing it, you may have to put 30% down, 40% down, in some cases 50% down, both from to cash flow properly, because you got to understand, when the interest rate is higher, that's a greater expense on you. So the rents you receive are only as high as the market will allow it to be. If you're paying more in interest, the loan is more expensive. Therefore, you have to put more down to make sure that it cash flows, and it typically at a clip of $1.25 for every dollar of loan debt. But beyond the fact that for the cash flow, that you need more money, banks are just requiring to lower their risk because they have a tighter or more bearish look on they're less risk, they're more risk averse in today's market. So they're saying, hey, if this person doing the loan puts down 30%, they're less likely to walk away because they put that much capital in versus somebody that puts down 15% or 20% or 10%. So it's a cash flow thing and it's a risk tolerance thing right now. That's what's happening at the regional bank level. The larger bank levels, let's call it, besides the big four, you have big banks that are maybe 500 billion in assets. Those banks are doing what we call soft hiring freezes, meaning not really opening up requisitions for new job hires, and also doing early retirement from a cost savings standpoint. So you're not seeing as much expansion in operations. It's just more conserving. And if somebody is 60 years old who may have retired at 65 or 67 or 70, they may be asked to retire early. Maybe individuals that they might be 50 years old, but they have 25 years, 30 years, 35 years with the organization, they're being asked to retire early. So you're seeing the larger bank levels, not quite the big four that are, trillion plus in assets, but $500 billion, $750 billion. Those banks are doing soft hiring freezes, early retirement for cost saving standpoints. Very stringent. They might say, hey, look, in the CRE department, we're doing none of that right now, unless their existing customers or their projects we already have in flow, their large developers like DR Horton or something of that nature. But otherwise, they've really slowed down in the CRE space. Regional banks have also significantly slowed down in commercial real estate, especially on the development side and certain verticals like office. Almost nobody's doing office right now because of kind of I wouldn't say the bubble, but there's a lot of problems in office that are pandemic related, people working from home. So that vertical is really not being touched at all. But at the larger bank level, soft hiring freezes, as well as early retirement at the regional banking level, a thirst for a push for non-interest bearing checking accounts, which means that you have to be aggressive in kind of going for strong businesses. Everybody's fighting for the same businesses right now to earn those deposits. Still doing owner occupied, but really kind of slowed down significantly in commercial real estate and rental properties. What that means for you is if you're a rental property owner, it's gonna be harder to find places, and it's time to refinance your loan because the note is due. It'll be harder to find places to finance that as opposed to 2019 when you did the loan, as opposed to 2017, 2020, 2021 when you did the loan. When it's time to refi now, there'll be less places to find. Secondary lending markets backed by private equity are the sources to go to. Because of where rates are, you're really not, if you go to a secondary lender, meaning a non-bank traditional bank lender, your interest rate fight is going to be the same. If they charge you prime plus one, banks are charging you prime plus one right now on investment property. The difference is they're going to charge you a greater origination fee or cost to do the loan than a bank would do. Typically at the bank, it's 1%. So if your loan is $1 million, then your origination fee is $10,000. If your loan is $1 million with a secondary lending source, it's typically 2%, 3%, so $20,000, $30,000. But your cost of the loan from an interest rate standpoint